Krishna, last week we ended higher for the end of the week, but I know it was still the worst performance that we've seen for 2019 on a weekly basis. Is that something that worries you, or is that just a signal that we've had a huge run since this year started?
I mean, it has to worry you. The trade tariff issues are real, and they have a direct impact on the economy. You know, if you think about it, the impact on the economy is roughly, let's say, $100 billion of financial consolidation, so half a percentage point in growth. We are coming off of a decent growth picture, so the economy can withstand that shock. But at the end of the day, the impact is going to be meaningful and significant. Having said that, the question as investors we have to ask ourselves is, let's say equities get derated and we go down another 5 percentage points. What do you do after that? And I think the answer to that is, well, the global economy is still decent. And even with this shock, we will probably grow at a decent clip. Policy support will probably intensify more, both here in the U.S. with potential Fed rate cut, and in China for sure with added fiscal stimulus. And I think that probably does enough of a job to support the economy.
But doesn't mean that if we go down another 5%, you would say to buy. You would say no, don't buy right now because you're worried about things. But if we drop 5%, you would buy on that dip.
Yes, I think the trend for the markets overall, from a long-term perspective, is still up. The two things in the last 10 years that have mattered the most is the Fed support of the U.S. economy and the Chinese support of the Chinese economy through stimulus. Both of those things stand. So the right model for dealing with the trade deal is the way we have dealt with Brexit, or the way Europe has dealt with Brexit, which is it's a gift that keeps on giving, and is probably going to be the case for a reasonable amount of time. Underneath that, though, we will have continued policy support, and probably the economy continues to grow. So re-rating, perhaps a re-rating takes place, and then we go up from there.
Mike, I have to say, if you really thought the trade deals were collapsing last week, I don't think the market really panicked at all. I think that probably most people are betting that you're still going to see some sort of...
No, the market didn't panic. The market entered last week in a position of almost looking for something to upset this happy scenario, right? I mean, you basically had this embrace of very good U.S. economy, better than expected, and the idea that trade was going to get done. I think what happens, though, every time you get, whether it is this kind of addition of trade frictions or back last quarter, the Fed seems like maybe it's getting a little too tight for where we are in the cycle, is it brings this conversation back to how much longer do we have in this expansion? What's the market telling us about that? Now we're back to looking at a very flat yield curve again. We're back in kind of the same treadmill, I think. And it doesn't mean we're going to get the wrong answer on that, but the market has to, I think, get shaken out a little bit. Every year but two, in the history of the market, you've had at least a 5% pullback from a high. We haven't had a 5% pullback from a high yet. And I do think you had this little bit of unleashing of volatility because of the trade issue. I think only in retrospect are we going to know if this was fully about trade.
I mean, we had earnings that came in that impressed everyone, and that was part of the reason that we really saw the momentum continue. What happens between now and the next earnings season? And
yet second quarter earnings forecasts continue to go down. So I think basically very good results relative to very depressed expectations in the first quarter. And I think that one of the issues that arises when you have this re-escalation of the trade issue is no analysts have an excuse to start taking up numbers, because that's, I think, what would happen. If you got a trade deal, first thing, all the firms go out and say, we're raising our estimates for industrial earnings, for example. What were you saying?
Well, so from a longer-term perspective, there is no issue. This is not a good situation. However, I think the trades and trade wars and tariffs is not something that helps the global economy. Having said that, I think the market perception is still very much that we'll reach some sort of a trade deal. It wouldn't be what anybody wants, but we will still reach some sort of a deal. Until that gets fully priced out, this is something that we'll be living with.
All the concerns about trade and tariffs before, we didn't really see it impact the economy here.
Well, so, you know, again, if it was a true trade war and we were restricting imports, that's very different than imposing tariffs. Tariffs, we can quantify what the impact is. Half a percentage point for the U.S. economy. If we were going to grow at 2 and change, then we grow sub 2 right now. But that's not the end of the world either.
Can I ask both of you about Uber? Do you have a take on Uber?
Well, so I think focusing on Uber from a near-term trading perspective is kind of missing the picture.
Okay.
Uber is really about a long-term growth story, and I think the long-term growth story will play out over the next 2, 3, 5 years. Wasting time as to how the IPO worked out and how the allocation process worked, I don't think is really helping the.
But as people look at that stock now fall below $40 this morning. Mm-hmm. There are some people who will either want to trade it, either they're going to want to sell or they're going to buy. There's going to be a question in the marketplace right now about whether all these private market investors actually know what they're talking about and whether this is, has been some kind of decade-long charade in Silicon Valley about how much these companies are really worth, whether public investors actually know better. I mean, I think that there's some larger things at play, and whether. Or is this all part of this China story and the market's just going to hell in a handbag?
Well, I think Uber is a combination of both. In a negative market environment, expecting Uber to do very well, I think that's unrealistic. I think Uber investors belong in two camps. It's like Tesla investors. So either you believe or you don't believe. And if you don't believe, you're not buying it. Doesn't really matter what the IPO has done. And if you believe that it's a long-term story and it'll play out, I think you are still a buyer.
There's a chance that it has a little bit of a feedback loop, though. It both reflects tough market conditions, and the fact that Uber did not trade well also feeds the sour market perception out there. I think it was just too familiar, too widely owned already as a private company, and it is a reality check, at least on the ride-hailing business. I don't think for Silicon Valley in general necessary.